Well, guys, I'm very excited to tell you that I have my good and long-term friend, George Gammon, on today. He is a macro educator and entrepreneur who's made his life's work to expose the hidden mechanics of the financial system. He has his whiteboards. They're excellent. He breaks down complex global risks in a way that anyone can understand it. And like me, he focuses on helping people see the structural shifts before they actually hit and become obvious. We are aligned in one mission, absolutely, empowering individuals to stay ahead of the system and protect their real wealth and their families. I am so honored to have him back on our channel again, George. So, George, thank you so much for being here today. It's been way too long, and there's so much that's going on. So,
That's right.
let's just kind of jump into the bugaboo word that keeps popping up, stagflation.
Okay.
Okay, I mean, it's kind of like a perfect storm, but if policymakers are trapped between inflation and recession, what's the one variable that they cannot control?
The labor market. So you have to look at the labor market because you go back to the 1970s. And when you had recessions in the 1970s, they were actually disinflationary once the unemployment rate spiked, even in the 1970s, right? So you look at 74, 75. You look at the end of the 70s going into the 80s. Even though it was a decade of high inflation, when you had the unemployment rate spike, you had disinflation. Now, inflation was still high, but like 74, 75 as an example, going into 76, I don't have the chart in front of me, but right off the top of my head, I think inflation was maybe 10, 12%, something like that. And going into 76, it was maybe 5, which again, is still very, very high, way too high. But the fact is you had disinflation. So I would suggest your viewers and your listeners to really, really focus on the labor market. So I would also like to remind them that during 2008, which we know how that movie ended, it did not end with inflation or stagflation. It ended with disinflation and deflation going into 2009. But during 2008, oil was doing what? Going to 140 a barrel.
Exactly.
Remember?
Hmm?
And
Yeah,
I'd also like to remind you,
wasn't that up from about 20 bucks a barrel or something like that?
I don't know where the starting point was, but it was in percentage terms, to your point, it was massive. I mean, it was massive. And what did we have during that time? You had the CPI going up. So and most people forget this because we just focus on how the movie ended, but we forget about how it started and what happened in the middle. And when the Fed started cutting rates in September of 2007, the CPI was at 3.5. Then you fast forward to July of 2008, and the CPI was at 5.6. 5.6. Why? Because oil created that short-term increase in the CPI. But it's not how the movie ended. The movie ended in the opposite, not with stagflation, but disinflation, deflation. And why was that? Because the oil price shock, if you want to call it that, was combined with a deteriorating economy and a deteriorating labor market. That's the key variable. That's what you have to look at. So what ends up happening is the oil price becomes a tax on the consumer and a tax on the economy. So they have to put gas in their car. They don't have a choice. But if gas goes from, I'm going to take it to an extreme just so we can get our head around it. If gas goes from $3 a gallon to $10 a gallon, now you have to take that purchasing power away from somewhere else. Yep. That's your discretionary, your disposable income. So therefore you spend less money at Target. You spend less money at Walmart. So whenever we see a cycle like this, it usually does start with an inflation or a stagflation, to your point, but that's rarely how it ends.
Yeah.
So that's what I'd have people focus on. Another thing I'd like to remind everyone, because I just did a video on this, is the ECB raised rates in July of 2008. They raised rates in July of 2008. when what, 2 months later they were at zero
Right.
because this
Right.
stuff absolutely hit the fan after Lehman Brothers. And this was after Bear Stearns, by the
Yep.
way. So why did they raise rates? Because they were scared of inflation. They're scared of stagflation, to your point. It's because they thought that the oil price shock would lead to a sustained level of accelerating inflation, as opposed to what it turned out to be, which was the straw that broke the camel's back.
Do you think that what's going on right now could be that straw in this
Absolutely.
highly elevated and overvalued market?
Absolutely. I mean, the parallels are staggering. I mean, the parallels are terrifying, actually. And in some cases, the parallels are infuriating. And what I mean by that is, you look at what's happening with private credit. Private credit is subprime credit. I
Right.
don't care if it's to another business or to a mortgage borrower that can't pay back the loan. It's still garbage. It's still toxic sludge on the balance sheets. And the banks are obviously exposed to that. Now, they might not have lent to the tricolors, if you will, directly, but they did it through the shadow banking
Exactly.
route. So now the shadow banks are blowing up, and we know and this is not just George Gammon saying that. Anybody that's been watching the news, it started with Blue Owl, and
Right.
then it's Blackstone. Now it's BlackRock. Now it's JP Morgan. Now it's Morgan Stanley. Now it's Deutsche Bank. All of these have come out and said that they have significant exposure to the subprime private credit. And oh, by the way, Cliffwater just came out on Friday. This is a roughly $40 billion fund. And they said that they are halting redemptions. Whenever you see financial institutions halting redemptions, that is a huge, huge red flag. And I don't know if you know this, Lynette, and I just did some research this morning, and this is where it gets maddening for your audience. So if your audience is watching, I strongly suggest they sit down and pour themselves that stiff drink, because this is going to piss them off. This is going to piss them off. So Paul Atkins was sitting on the board for Cliffwater, which is a fund that's most likely going to go the way of Blue Owl, which is most likely going to go the way of Lehman Brothers, if we're just being honest here and looking at the probabilities.
Right.
So Paul Atkins was on their board of directors. This is Cliffwater. Now, he quit in the middle of 2025. Why do you think he quit? Oh, that's to become the chair of the SEC. That's right, the chair of the SEC. And what do you think Paul Atkins, by the way, was doing between 2002 and 2008? He was a commissioner at the SEC. So while all this fraud was going on under his watch prior to the GFC, which led to the GFC, this was Paul Atkins was your guy. And then what did he do? He gets into the private credit space, and then he quits that in 2025 because Trump nominates him for the new SEC chair. And by the way, what do you think he wants to do now? He wants to get rid of quarterly reporting for publicly traded companies.
Right.
Why? Because he wants the publicly traded companies to be more of a black box, just like the private credit guys that have been able to keep up this ruse, which is effectively a scam. I mean, let's just call a spade here.
Right.
BlackRock came out the other day, just last week, and told investors, told the public, the media, they disclosed the fact that the loans that they had valued 3 months ago. Think about the underwriting here. There is no underwriting.
There is no.
It's lies and BS at the end of the day. The loans that they valued 3 months ago, not 3 years ago, 3 months ago, at 100 cents on the dollar, they just came out last week and said, oh yeah, by the way, sorry guys, we had to revalue them. Oh wow. Would you have to revalue them at 90 cents on the dollar? No, that would be 0 cents on the dollar. How can any underwriter, unless they're just giving you a line of BS, which is the bottom line, how can any underwriter say something is worth 100 cents 3 months ago, and today it's worth nothing? It's worth absolutely nothing. And the whole point there is because they're trying to pull the wool over your eyes.
Yeah.
Because why would they do this? Why would these private credit guys try to invest or try to create a model that's so opaque where there's absolutely no disclosure, because you have to just trust them. You have to say, oh, no, you want a redemption? What, are you crazy? Our fund is up 20% year to date. Oh, it is. Based on what? Based on all the valuations. Really? Well, who's doing the valuations? Well, we are. Our underwriting. Okay, but that's unrealized gains, right? Oh, yeah. But, well, how do you know it's worth 100 cents on the dollar? Well, it is. It just is. That's our, it is. You think we'd invest in something that could go bust? Oh, absolutely not. So what they're doing here is it's a free call option. Lynette, you know how this works. You know how the game is played. So for one of these fund managers, they have no risk and all upside. That's why I call it a free call option. So they take in $10 billion and it's all marketing. It's all smoke and mirrors marketing. It's all a ruse. And some, me included, would go so far as to say that it's an absolute scam, because they know that they're investing in garbage companies that will never, ever, 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 ever pay them back. Just like the banksters knew that they were giving loans to people that could barely fog a mirror back in 2007. And by the way, remember, the guy that was supposed to be the watchdog back then, when all of these mortgages were going out to people that could barely fog a mirror, now he is the guy that's in charge of the SEC today, that came from one of these private credit funds. I mean, you can't make this stuff up. You absolutely can't make this stuff up. So what these guys do is they sit there and try to find anyone with a pulse, and then they lend, quote unquote, lend to them, and they try to convince their investors that this is somehow a risk-free return. It's just like buying a treasury, except with a treasury, you only get 4%. With this, you get a 12% return, risk-free. What's not to like? That's the marketing. That's the game that's being played. And now we're in the stage. I just interviewed Ed Dowd on this, and he put it perfectly. We're in the Ponzi scheme phase of the cycle. And what that means is the only way these private credit guys can pay anyone back at 10 cents on the dollar is they have to take other people's money to give them liquidity, right? So you have all of these redemption requests, and they sit there and tell you to pound sand because they can't sell those assets, because those assets aren't worth anything. So what they have to do is they have to go back to the bank and actually borrow money to pay back their investors that are requesting the redemptions, but they will only give up to 5%. Anyone over 5%, as far as the value of the fund, they won't give them their money back. It's literally a bail-in, like Cyprus, where they're sitting there telling their investors that, no, sorry, we need your money more than you do, and therefore you can't have it back. And the only way we can even pay off the 5% that got in early, thank goodness, is if we borrow the money to give it to them, or somehow dupe some other investors into giving us money that we can pay off the current investors with. It's the absolute definition of a Ponzi scheme. And before we went live here, I was looking at CNBC, and now they're claiming, all the private credit guys are claiming this is a fantastic. They have this new marketplace that's going to be the off ramp for all the investors, the poor saps, the bag holders for private credit, is if they want a redemption, but the BlackRock, the Finkster, the Finkmeister won't give it to them, then they can go ahead and take their shares of that garbage fund and that toxic sludge, and they can go ahead and sell it on the secondary market and then get that liquidity. So then, of course, what's going to happen is the BlackRocks are just going to go into that secondary market, and they're going to buy it at 99 cents on the dollar, because they're buying their toxic sludge just to market at 99 cents, just so no other investors want a redemption. I mean, and then are they going to worry about it, about going to jail? Absolutely not. Why? Because look who's watching the hen house.
Right.
It's the same. It's the same guy that was there during the GFC, and he's one of their buddies. He goes to lunch with all these guys. He was part of the private credit fraternity, if you will, just going back to 2025.
Yep.
And now he is, I'm saying this over and over again, but it's the way to describe it. Now he's the fox that's watching the hen house. And so think about this. You've got massive fraud going on. Does that sound familiar?
Yep.
GFC, you have massive fraud. You have a blow up in what effectively is subprime credit that will absolutely impact the balance sheets of the banks. I mean, again, we had JP Morgan, the big dog in the room, the 800-pound gorilla, even admitting that it's going to impact their balance sheets and they're going to have to write down some of these loans that they had as collateral, right? And so now, am I saying that JP Morgan's going to go bust? No, I'm not saying that. Am I saying that we're going to have a GFC that's going to be exactly like what played out in 2008? I'm not saying that. I'm absolutely not saying that, because rarely do you have a crisis that unfolds in the exact same way just 15 years later or something. But what I am saying is our economy and the global economy depends on the circulation of money and credit.
Yes.
It does. We can not like that. We can hate it. We can whatever. The bottom line is it depends. It's like oil in an engine. You have to have money and credit circulating. If you don't have money and credit circulating, the whole thing seizes up. Just like your car running out of oil. So what happens is the Fed doesn't control that with bank reserves, because it's all about risk. Because I don't care how many bank reserves a bank has, if they see massive amounts of risk out there, they're not going to lend. They're not going to circulate the money and the credit. It ain't going to happen, right? So it's all a function of perceived counterparty risk. So if you have all of the cockroaches blowing up, let's say, and by the way, why do you think Jamie Dimon was so prophetic in calling out the cockroaches?
He knew.
Because he was a cockroach.
He knew, right?
He was one of the cockroaches. That's why. He had a front row seat to what was happening. He didn't have a crystal ball. He was one of the guys. So anyway, going back to how the real problem here, because most people, they make the mistake of just looking at the direct impact of the balance sheet on the banks. So as an example, they'll say JP Morgan had $5 billion of exposure to private credit. Therefore, their maximum loss would be $5 billion, and that they're not going to go, or that's not going to be a big hit because I'm just making up numbers, because their balance sheet is $5 trillion or something like that.
That's right.
But that's the wrong way to analyze this, because again, you have to look at it through the lens of circulation of money and credit. So if you have the cockroaches blowing up, what does that do to perceived counterparty risk in the financial system?
Yeah.
It increases. Okay. If JP Morgan is having to write down some of these loans that they had as collateral, are they going to have the ability to circulate money and credit? Absolutely they will. They don't need bank reserves for that. Are they going to have the willingness to do it? That's a much different story. And the answer to that is no. The GFC that we had was really not a subprime crisis, in my view. That was kind of the straw that broke the camel's back, along with oil and everything else. It was an extremely weak economy. Look at the non-farm payrolls. And that's kind of what tipped it over the edge. But the reason we went from just a normal recession into a GFC is because the circulation of money and credit stopped.
Yep.
Why did it stop? Because what they were using as collateral for the circulation of money and credit was something called a mortgage-backed security. And when you're circulating all of this oil for the engine at those mortgage-backed securities being valued at 100 cents on the dollar, and all of a sudden overnight they're valued at 10 cents on the dollar, there's no more collateral. It's gone, other than treasuries. And if there's no more collateral, there's no more circulation. If there's no more circulation, the engine freezes up. That's really at the core of what took 2008 from a dot-com bust recession into a global financial crisis. So you can't sit there and ask the question, well, what's JP Morgan's exposure or Wells Fargo exposure directly to Blue Owl? That's the wrong question to answer. You have to answer the question, what does this do to perceived counterparty risk in the financial economy with the financial institutions? And what does that do? Could we see a seizure as a result of the circulation of money and credit, which then would lead to a GFC type of event, a very severe recession? Now, would the banks go bust? No, because even if they got into trouble, we've got a knee jerk, we got a hair trigger right now on them being bailed out. by the, you think, honestly, you think Trump is going to let JP Morgan go bust or Wells Fargo? Absolutely not. Absolutely not. They're going to, if they do get in trouble, which they're in much better shape than they were, just looking at their balance sheet, in 2007 and 2008. But even if they do get in trouble, they're going to get bailed out. So I'm not saying that it's going to look exactly like 2008. I'm saying in the economy, the way it's going to feel is the same way. So what I mean by that is the unemployment rate, it likely spikes, just like we saw during the GFC. Now, does it go to 8%, 9%, 10%? I don't know. But it likely we see something like that that impacts the vast majority of Americans. And let's not forget, Lynette, you know this as well as I do, that the U.S. economy, unfortunately, and it's even worse now than it was prior to the GFC, is totally dependent on asset prices. Totally dependent. So if you look at a chart right now, the S&P, it looks eerily similar to a chart in 2007, 2008, where you hit that high going into the new year, and then it starts to just roll over, just starts to roll over. And so now it's different from the standpoint that the economy is much more dependent on these asset prices, and the S&P 500 is far more dependent on passive inflows. Mike Green talks about this all the time, right? He's spot on. So what you have to do, going back to the labor market, the first question that you asked me, is you have to look at the unemployment rate, because that's really your proxy for when those passive inflows become passive outflows, right, into those S&P index funds. So, and I've talked to Mike about this. We had lunch for 2 or 3 hours just a few months back, and I asked him, I said, do you have any models, or have you done any models that tell you what the unemployment rate needs to be in order for there to be net outflows from net inflows? Which is the whole thing that's keeping up the house of cards S&P 500 as we speak, right?
And just to be clear, to help people understand the context of this, when you're talking about the employment in and out, are you talking about the contributions to the retirement plans supporting the market? So I just wanted to, I thought you were, but always good.
Yeah, so thank you for clarifying. So basically, you got your average Joe, he makes $5,000 a month, and 10% of that goes straight into an index fund, because that's what Dave Ramsey tells him to do. And so, and now does he choose? No, it's just it's not discretionary. It's just every single month, 10% of his paycheck goes into that S&P fund, and that's not discretionary. They just $1 in, you buy $1, right? There's no valuation, there's no anything. So that's so many of your viewers, I'm sure, sit there and they look at the stock market, which is in an absolute bubble. No one's going to dispute that. But they sit there and say, well, it just keeps going up. It just keeps going up. And regardless of how bad the economy gets, regardless of what happens, the stock market, it just always goes up. I don't know why. It's always, it's all, you've got to buy the dip, for heaven's sakes. Why is that? Why can there be such a disconnect and often an inverse correlation between the real economy and the S&P 500? Yeah. There's a lot of reasons, but the main reason is because of these passive flows, where the stock market is just turned into everyone's retirement fund. Right. That's not the purpose of the stock market. It shouldn't be your retirement fund, but that's what it's turned into. And people have just become robotic, right? Because they're now so complacent, because they have recency bias, and you look at just the last 20 years or whatever, and if you buy the dip, and if you just do this passive investing, you don't have to pay a manager 2 and 20. You just pay the 50 basis points in your S&P index fund. Dave Ramsey and everyone on social media tells you that that's the right thing to do. So you have people doing this in mass, and and they don't do valuations. They don't care if it's in a bubble. They don't care what's happening. They just invest that 10% every single month. And that's what drives the S&P higher and higher and higher. So that's why the unemployment rate is so important, because once Mike said about 5.5 to 6 as far as his read on the unemployment rate. But once it gets, let's say, 6 or 7 on unemployment, then based on his models, you go from a net inflow to a net outflow. And then that huge tailwind that we've had in the S&P 500 for the last 20 years becomes a headwind. and it becomes a headwind at the exact wrong time, right? And oh, by the way, you've got AI that all else being equal. Let's just say we don't go into a recession. AI in and of itself will likely take the unemployment rate to, I mean, let's be conservative and say 7%. Yeah,
Well,
6 or
I mean,
7% in the next
Meta
couple of
just
years.
announced a 20% layoff, and that
Yeah.
Trini piece that came out recently saying how AI would take these jobs, and then there were all these articles. Oh no, you're being ridiculous in the face of actually all of these major AI companies laying people off
Yeah, Block laid
and
off
openly
40% of their
say,
workforce.
"Pardon? I'm sorry."
Block, that's Jack Dorsey's
Right,
most recent company, the guy that started Twitter. He just laid off 40% of
exactly.
his workforce because he's trying to switch to an AI model. You know, I get pushback on this. That's to me is a little bit bizarre from the standpoint of they say, well, that's not really going to impact the economy because the robots or the AI or whatever, you know, they're more productive. So you're going to have GDP actually increase because the AI is more productive than the humans. I'm like, okay, that's great, but who's going to buy the widget?
Exactly.
Who's going to buy the widget that the robot is more productive in producing?
Yeah.
If no one's got a job, then there's no aggregate demand. Now, we could go into a world, which I think we will go into, by the way, in the next, I wouldn't be surprised if we went in the next 3 years, but this world is UBI. And I've been talking
Oh,
about this
we
since I
have
started
to.
my channel in 2019.
Yeah.
But
Yeah.
yeah, I think you go into a UBI world because it's going to be just like the cerveza sickness. There you go. There you go. Where
UBI
instead
world,
of STEMIs, it's UBI because, and we'll use the exact same excuse, right? Remember the excuse that we used during the cerveza sickness? Well, all these people had to, and this argument was actually correct, where all these people had to quit their jobs or not going to work or their business had to shut down because of the government locking you in a cage, and it's at no fault of their own, and therefore let's just give them quote unquote free money. And they're going to have the exact same argument with. Now, I agree with the argument. I don't agree with the quote unquote solution, which caused, or one of the main causes of the inflation that we've had over the last few years. But they're going to use the same argument again that, oh, this truck driver, you know, he didn't lose his job because he didn't show up or he was incompetent or anything like that. He just lost his job because now a robot can do it a lot better than he can. It's at no fault of his own. And we're going to go into an economic death spiral if we have, you know, mass unemployment, just like the Great Depression. So what are we going to do? We're just going to give people free money, or they're going to do some thing like FDR did. I always say that Trump is like FDR 2.0.
Mm-hmm.
He's like FDR on steroids. You know, did you know that the only person that had more executive orders than FDR in the first like 3 months of his term was Donald Trump, and he outdid him by like double. So anything that FDR did in the Great Depression, I would argue that Donald Trump will most likely do the exact same thing, but 10 times bigger, because that's what Trump's all about, right? So if FDR had a work program where you basically hire people to dig holes and then fill them back up or whatever, whatever they did, you know, we're most likely going to have a government sponsored work program in the United States for all the people that are displaced with AI.
But what does that do to the money? Right? There's no such thing as a free lunch. And when people think that they'll give out free money, it's not free. It's not
And
free.
yeah, the prices, to your point, the price of stuff's going to skyrocket
Right.
because the only prayer that we would have there is that AI is so productive that they're able to produce enough stuff to keep up with the expansion of the aggregate demand, right? And now that goes back to the Austrian theory, which I think is completely correct in the sense that you can't just look at what the prices are today. You have to look at what the prices would have been,
Mm-hmm.
right? So let's just say for a moment that the robots are so productive, they produce so much stuff that we don't have inflation, that the price increases are zero, because it's just offsetting all of the quote unquote money printing, all right, or velocity of money or whatever's happening in the UBI. But that's not looking at it the correct way, because if it weren't for the quote unquote money printing, then prices would be going down. They wouldn't be flat.
Right.
And that would be a huge, the biggest benefit that could accrue to the poor and middle class, the average Joe and Jane, is deflation. But it's the deflation that is a result of more goods and services. Unfortunately, with the economy that we have right now, usually the deflation that you get is not a result of more goods and services. It's a result of a credit collapse, which leads to less demand, not more demand.
Right. Yeah. And I mean, when you look at what's happening today, I mean, part of what we were talking about going back to the private credit is that in the beginning, like it really took off after 2008. Why? Because of all of this free money and then the banks seeming to step back from this riskier lending. And that's when really you look at it, before it was available, or what they like to call democratized, that's when all the money was really made and the setup. Once that started, the large money started or stopped coming in as easily, that's when they decided they needed to democratize the market so that the normal mom and pop can get into what they have no idea they're doing. No idea.
Yeah, and it's all a result of central planning.
Yeah. Yeah.
I always say that are the banks the problem? No, they're not the problem. It's the government. That's the problem. Because if you got the government out of the banking system, you'd go back to free banking where they actually had to keep that garbage on their balance sheet and they could actually go bust. And in that environment, guess what a bank's going to do? They're going to lend in a very prudent fashion. And if they do increase the money supply by lending it into existence, which is what they do, they're going to lend it for productive purposes. They're not going to lend it for speculation. They're not going to lend it to Blue Owl. I assure you of that. They're going to do things prudently. The problem is the government. So go back to 2008, exactly what you're saying. I want to make sure your audience picked up on that. And coming out of the GFC, we had the Dodd-Frank bill. Remember that? Dodd-Frank, which, by the way, these were the two guys that were probably the two biggest contributors to Barney Frank and Chris Dodd. I think Chris Dodd, that was his name, right?
Right.
These were probably the two politicians that contributed the most to the housing bubble. Of course, these are the guys that come out with all the regulations as to how to control the banksters. So they come out and they had all of the, as Dodd-Frank, there's a bunch of these regulations. The bottom line is it prevented the banks from lending to, let's just say, these subprime borrowers. So what are the banks going to do? You think they just aren't going to accept that money anymore? They just said, okay, we're going to stop being greedy. Of course not. They're just going to they're going to be one step ahead of the regulators, which they always are. So what they do is they just set up private credit. They just set up shadow banking. So the JP Morgan can sit there and say, oh no, we're not lending to that subprime borrower, Tricolor. No. Are you kidding? No. We're squeaky clean. We're obeying the rules. We're lending to Blue Owl. And Blue Owl, let's just use credit scores to keep it easy. Blue Owl, he's not like that Tricolor guy that has a 500 credit score. Blue Owl has a 780 credit score. So this keeps our balance sheet pristine. But then what we can do is we can charge Blue Owl the 5% when we're only getting 4% on a treasury, let's say. And then Blue Owl can charge Tricolor 12%. And then everybody wins. You're still getting money to Tricolor, but you're just circumnavigating the banks through the shadow banks just to get around the regulation. And why are they doing this? Because they were bailed out to begin with. So if you wouldn't have had the bailouts, if you would have just let them go bust, and then you would have had all these additional regulations, I can assure you we would not have the issue that we have today with private credit, which is just deja vu of what happened when Ben Bernanke came out and said that, oh, don't worry, Lynette, subprime is contained. Subprime is contained. What are the probabilities that we start to see the head of the SEC, or we see the next Fed chair, Warsh, or whatever his name is? What are the chances in the next year he comes out and says that private credit is contained? I'd be willing to bet you like $100 that they won't even try to hide it. They'll use the exact same phrase. Oh no, subprime is contained. Oh no, 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 2008 today. Oh no, 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 private credit is contained.
That's what
It's
we're
the
hearing
exact same
right
ruse, and you
now.
got to point your finger at the government.
Yeah, I agree. So, you know me, we've known each other for a very long time. And, my fight is to take our power back, the public take the power back.
Yeah.
And the only way that I see, so I'm open to suggestions, but the only way that I can see that is if there's a redeemable component to the new monetary system that's coming in. And I don't see why there cannot be, other than if people don't demand it. Because the government, who's gonna opt for that? That forces fiscal responsibility and would eliminate their ability to do all the stuff that they do.
I have a more pessimistic outlook on that. Why? Because human nature, right? So let's back up. What we're talking about is trying to constrain the central planners from doing these bailouts, which distorts the price signal, which distorts free market capitalism from doing what it does well. And at the end of the day, giving the power to the people. Assume we are using gold coins as money. Just let's assume that for a moment.
Okay.
Now, can the government print this? No, they can't, but they can tax it.
Mm-hmm.
They can say, hey, we're going to charge you a 40% income tax on your gold, so you give us the gold. And let's remember that the 40% or whatever our highest marginal rate is right now, that was put into place by politicians that people voted for.
Mm-hmm. Mm-hmm.
Let's remember that. So even if we had sound money, even if you had a set money supply with Bitcoin, or a money supply that increased by 2% per annum with gold or something like that, we're still at the mercy of human nature. And if we get an event, whether it's planned or not, like the cerveza sickness, where the government can come out and say, pants on fire, pants on fire, pants on fire, the whole world's coming to an end. We have to increase taxes because it's for your own good. We have to increase taxes or else the whole system's going to collapse. We have to increase taxes or the way of life that you've become accustomed to is going to go by the wayside. Just fear, 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 right? And say the only way that we can get out of this is if we increase the tax rate from 10% up to 20%. So at the end of the year, you just give us 20% of your gold instead of 10% of your gold or whatever it is. And people are unfortunately are going to say, yeah, if the government can scare them to a certain degree, the people are always going to capitulate. So that's why whenever I have these discussions or whenever I do videos on this topic, I try to focus on the size of government above everything else. Because if we have sound money, the government can still tax it and people can still vote for it. If you have the emphasis on small government, that I think highlights the downside risk, let's say, to people pursuing that impulse that is human nature. The example I always use is The Silence of the Lambs. I'm sure your audience remembers that movie. Remember the first one? You had Hannibal Lecter. Mm-hmm. And Jodie Foster's character, you had Buffalo Bill, I think the guy's name was. Yes. He was out there running around killing people, crazy. And she was left with a choice where the only choice that she had was to try to talk to Hannibal Lecter, which was incredibly dangerous. Could have been worse than trying to go out there and just, roll the dice with Buffalo Bill. But she did that because it was her only option. But she understood how dangerous it was. So that's the way I'd like to look. I'd like to have people look at the government, just like Hannibal Lecter. where you need to understand that if something happens, heaven forbid, where we actually have to use the government, let's say to protect our borders or something like that, you have to understand that you are giving power to Hannibal Lecter. And you got to be very, 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 very careful with that. Whereas in today's society, we don't see the government as Hannibal Lecter. We see the government as our savior. We see the government as the good guy, not the bad guy. And why wouldn't I want to get the government even more power? Because we have all of these, private credit issues. And every single time this blows up, everyone blames it on free market capitalism. So we just need more government. We need more government. We need more government, where we have to understand that that's the problem to begin with. And if we just treated government as though it was Hannibal Lecter, I think we would all be better off, regardless of what system of money we had.
Well, I agree with what you just said 100%, but let me also add, and using that same analogy, that there were, at least he had a mask on so he couldn't eat her with fava beans at that moment anyway. And there was also a cell between them. And I think the piece between having something that is backed by gold, like we're seeing in Zimbabwe, versus redeemable gold, I think that is the protection that we need. And whether or not you actually do redeem it, that would also eliminate the ability to tax it. So there's a few different things, but I view this as protection and freedom, because freedom isn't free either. You have to fight for it. And I do agree, most people will not. But hey, it was a very vocal 3% that started the Revolutionary War. And if this isn't the time for another monetary revolution, because the other thing that's been quite interesting to watch since 2008 is the rise of socialism and what they're fighting for. And you remember 2008, there was a global movement, Occupy Wall Street, and I didn't have a voice at that time, but I remember seeing they don't understand what they're upset about. They don't understand that it's the money system, it's the rules and all of this. And I would say the same thing that I'm seeing for socialism, especially when they're talking about rent control. How about monetary control? And that's what I'm trying to figure out. We have got to, I agree with you, smaller government for sure. And the Federal Reserve, we don't need them, but we've got to have a tool for the public, and voting isn't it. Voting doesn't really mean a whole lot. So we've got to have a tool to put the power back in the public's hands. And so far, all I can see is redeemable gold that would do that. And it might be the longest shot in the universe, but you've also been to my farm, right?
Yeah, I mean, there's no downside in it. There's no downside in it. And again, the hesitation I have is, we were on a gold standard until 71. And if you look at the government spending as a percentage of GDP, I mean, even go prior to the, Roosevelt, prior to the 1930s and the 1940s, you just look at the expansion of the government. And it didn't matter what money supply you were on, it grew and grew and grew. And the metric I'm using there, Lynette, is just the government spending as a percentage of GDP. The only time that you didn't have the government grow as a terms of percentage of GDP, as far as I can tell, is prior to the Federal Reserve, and when you actually had the government out of the banking system. Because let's remember, even during the 1800s, you were on I guess you could say, the strictest gold standard that we had ever been on, or monetary standard, or metal standard. I'm not sure what they called it back then. Bimetal. Okay, thank you. But in the late 1800s, the money supply grew actually faster than it has grown today. So, as an example, if you look at 1880 to 1885, M2 money supply grew at a faster rate than it grew from 2020 to 2025. So why is that? Because the banks were creating the money. They were lending it into this. And when I'm using the term money, I'm just using currency units.
Currency,
I'm
right,
using the
right.
bank notes is probably a better way to say that. But those bank notes were being used as money. They were being used as currency. They had purchasing power in the real economy. So although they were backed by gold, at the end of the day, the gold was just a very small fraction.
Right.
And the bankers were creating the quote unquote money supply by lending it into existence to a degree to which was even more extreme than what we see today, when back then we were on the strictest gold standard, and today, by any definition, we're on a strict fiat standard. So you somehow have to figure out a way to, if you want the money supply to stay static or to grow at just 2% per year, you have to figure out a way to prevent the banksters from lending money into existence. And I don't know how you do that, because at the end of the day, the reason they're able to lend money into existence is because there's demand from the general public. If they're filling demand, ironically enough, it was a free market solution to the demand. And where was the demand coming from? Cheaper loans, right? So if you have a fractional reserve system, if you want to look at it that way, that fractional reserve system will yield lower interest rates than a full reserve system. So you ask someone, do you want a 10% mortgage or you want a 5% mortgage? And the person's going to say, well, I want a 5% mortgage. And the bank's going to say, okay, well, we got to do this fractional reserve lending thing. And say, okay, fine. Just give me the 5% mortgage.
So there is something that you said, because I know that what you're saying is truth. And I need to send you these links to this data that I came across, because what happened was we went off the gold standard in 1913 and 1914 when they legalized the Federal Reserve. So before that, it was just ebbs and flows. It wasn't booms and busts. And the reason why you saw all of that government spending was because they modified it. They needed what they called flexible money. And so where this little itty bitty 20th of an ounce of gold backed $1, when they legalized the Federal Reserve, it now backed $2.40. And I have all of that data and all of the proof of how they took us off the gold standard, then using corporate debt as our new currency. And I'll send you those links, and I'll send you those charts, and they will blow your mind.
And you could argue they did the exact same thing during the Civil War.
Yep,
right?
exactly.
They create a crisis. The government creates a crisis. And what do? In fact, you know what was funny? I did a video a long time ago where I don't even know how I found it, but I found like the meeting notes or something like that from a lot of the politicians during the Civil War, when they were trying to figure out, and they were debating back and forth, how are they going to fund the war? And they actually chose printing money as opposed to issuing bonds, because they thought that issuing bonds would be unethical, because people would have to pay an interest rate, or they'd have to pay an interest rate. The taxpayers would have to pay an interest rate to fund the war, as opposed to them just printing money and then no one has to pay for it, right? So even the point there is, even during a gold standard, if the government creates or fabricates or convinces you that the crisis is big enough, and they still print money.
Right. But then that's the job, your job, my job, anybody in this space's job that are keen on education, because how many times can you be lied to when you don't know the truth? At least it feels like you can do something. And then I know we're going long, and I want to have respect for your time, but there is one more thing that I want to talk to you about.
Sure.
Because it's kind of come up, but we've sort of skirted it, and that's the derivatives. And so when you're looking at the private credit and everything that's happening in this space, and then going back to 2007, right? It's been really the rise of derivatives, which are just these big opaque bets that the guys that create them, the JP Morgans, the Morgan Stanleys that create this garbage, hide the real value that is at risk. My concern, or my belief, I should say it's my belief. And this is my opinion, and I could be wrong, probably not, but I could be wrong, that this next implosion, because I think it was a derivative implosion. It was the mortgage-backed securities. So it was the derivative bet implosion that overwhelmed the system. I think this is going to be much bigger, because up until 2009, central banks the derivative exposure was it was still an experiment. Now, after 2008, it has been embraced on a huge way. And in fact, I just looked at the most current Office of the Comptroller of the Currency Derivatives in the FDIC insured banks. And in there, the netting benefit, so this derivative contract, even though they're not exactly the same, offsets this derivative contract, was 88.4%. So based on the level of derivatives that were reported by the FDIC insured banks, and assuming that that 88.4% is accurate and truthful, just the level of the derivative contracts were close to $7 quadrillion.
Yeah. And what's perversely ironic about that is that's a bid for dollars. So what I mean by that is, if there's a mortgage-backed security, if you own a mortgage-backed security, that's your asset, but that's someone else's liability.
Mm-hmm.
And in order to satisfy that liability, what do they have to get? They have to get dollars. They can't get euros. They can't get gold. They can't get Bitcoin, silver, anything. They have to get dollars to satisfy that liability. So if there's $7 quadrillion worth of derivatives, that means there's $7 quadrillion worth of demand for dollars, right?
So is that
what does that mean?
Yeah.
That puts you into an environment where you could have, in the United States, extremely high levels of consumer price inflation, while at the same time, the dollar was skyrocketing in value relative to the euro or the yen. I mean, look at the poster child for this, the yen, or, XYZ currency, just throw it in there. Because what we have to realize is the dollar, the vast majority of dollars, they're not printed by the government. They're not printed by the Federal Reserve. They're lent into existence by banks. So every single time that a dollar is created in that system, there's an offsetting liability. So when a dollar is created, it also creates an offsetting demand for that dollar in the future, right? And derivatives are just, it's loans, it's demand, it's dollar demand stacked on dollar demand, stacked on dollar demand, stacked on dollar demand, stacked on dollar demand. And fortunately, with those derivatives, when you're not in a crisis, they can be settled with other derivatives, right? So you just go back. You don't actually have to have $8 quadrillion to settle, because there's like futures contracts that they're settled with something other than the underlying asset. But in a crisis, they ain't. In a crisis, if you've got a futures contract for oil or for gold, you want the gold, you want the oil
delivery.
Yeah, you want delivery. So you get to this weird, like I said, perversely ironic situation where the dollar just completely crushes every other currency in every other country, quite literally, in every other economy, if you have the blow up in the derivatives, while at the same time, the dollar is losing value relative to goods and services in the United States.
Yep. And actually, I talk about that all the time, but what really matters, it doesn't matter how many zeros. Like, where is this? Here's my $10 trillion Zimbabwe note. Lots and lots and lots of zeros, but I can't buy anything with it. And, I do this all the time too, because it's just an interesting exercise. If I'm talking about another country and another currency, I just go into an exchange like xe.com or one of those, and you could put in the US dollar against their spot gold contracts and then against the spot silver contracts. And actually, the dollar is frequently up against other currencies, which really only kind of matters when you're traveling. But against us, even the spot contracts outperform the dollars against all those other currencies. And it's just an interesting exercise to do, because it doesn't matter. You know, this 10 trillion, I'm a trillionaire that I can't buy anything with it.
Yeah, that's right. That's right. I mean, here in Colombia, I'll go to lunch next and I'll probably spend probably 40,000 on lunch. The 40,000 pesos. That's like $10.
40,000 pesos. And what will you have for lunch, George? What will 40,000 pesos get you?
Oh, actually very nice. I eat the same thing for lunch. It's like quinoa and feta cheese and chicken breast and sweet potatoes. It's all, they give it to you like in a bowl. It's fantastic with like a vinaigrette on top.
Wow. That sounds like a lot.
It is, and it's delicious.
I bet it is. I need to come down and visit you there. I haven't made it. I did make it to Panama, though. So I have started my trek into a little bit. I know that's more Central America, but I need to make it down south. We'll make it happen.
Absolutely. Absolutely. And I think what I'd like to leave your viewers with is not like doom and gloom. I know it kind of sounds funny to say that because that's our whole conversation here. I always love listening to my good buddy Doug Casey, because he is literally the world's biggest pessimist. But every once in a while at the end or during one of his podcasts, he'll always say that he's an optimist. It just like cracks me up, because he literally is the biggest pessimist in human history. But anyway, no, I just look, are we going to have a GFC 2.0? I don't know. There are only probabilities. There are no certainties. You have to look at the probabilities. And in 2026, they are way higher than they were in 2025. And by the way, in 2025, I think they're way higher than they were in 2024. Right now, you have a perfect storm. You have everything, every component that we had leading up to the GFC, you have right now. That you can't debate that. Right. I don't care how bullish you are, you can't debate that. So when you look at the price of oil, when you look at the labor market, when you look at the deteriorating economy, the revisions to GDP, the everything that we've discussed on this video, it is at the fraud. We have the same guy in the SEC, for heaven's sakes, right? It's absolutely identical. Does that mean it plays out the same way? Probably not, because it's like the butterfly effect. There's so many millions and infinite amount of variables that even if these things line up and they're perfectly parallel, the probability that we have the exact same outcome is incredibly low. But the probability that this cocktail, if you want to call it that, this perfect storm leads to something other than a recession or an economic contraction or a drop in the S&P 500 or drop in home equity, the probability that it leads to something other than that is also very, very low. So what you have to do is you have to protect yourself, and education and having your eyes open is half the battle. I always tell people that burying your head in the sand like an ostrich is a very, very poor investment strategy. So the fact that someone is watching this video right now gives them an edge. It makes them aware of what's going on. Now, that doesn't mean that you lose sleep at night. It just means that you set yourself up to where you're prepared. So, and if you are prepared, when you come out the other side, it's just like the yin and the yang. The bigger the crisis, the bigger the opportunity. Just like we saw during the GFC, by the way, and just like we saw during the cerveza sickness. The March of 2020 was one of the best opportunities to buy stocks in human history. Right? One of the best time to buy oil stocks, one of any stocks for that matter, because everyone thought the world was coming to an end. Yeah. And so, but it was only, that opportunity was only available for people that were prepared. So that's kind of the message that I'd like to leave people with.
That is a perfect message. And that's what I am all about too. Food, water, energy security, barterability, wealth preservation, community, and shelter. Get it done, because you can't stop what's happening, nor should you. quite honestly, to your point, George, there is so much garbage embedded in the system that it has to change. I'm hoping that, and I agree with you 100% as well, the opportunities that present during this change and this transition, if you are prepared, you can be in a much better circumstance. You can weather the storm we're going through, but you can be in a much better circumstance on the other side of this.
And more importantly, you can be in a position to protect your family and your friends and
Exactly.
family, the people that really matter the most.
Exactly. And my goodness, if we could actually get a redeemable gold back in the system, we can help the world. Why not? Isn't that why we're here? Right?
That's right. Redeemable gold and Hannibal Lecter.
Exactly. That protects you. I love that. That's a great image. Thank you so much for being here. And how can people find you? We're going to have all of the links below, etc. But
They just go to
do a little self-promotion, George.
they just go to my YouTube channel, take your pick. The whiteboard videos are the most popular. That's the George Gammon channel, just my name. And the live streams that I do almost daily, is talking about this stuff with private credit and everything else. That's the Rebel Capitals channel.
Yep. And you have an event coming up in May as well.
I do.
So
I do. Rebel Capitals Live. Rebel Capitals Live. But if you subscribe to especially the Rebel Capitals channel, you'll hear me talk about Rebel Capitals Live all the time and how to get your tickets and the speakers. We had Lynette there one year. We've had incredible, well, people not as incredible as Lynette, but people that are almost as incredible as Lynette. People like Robert Kiyosaki, Ron Paul, Doug Casey. I was just referring to Mike Green, Lynn Alden, Chris McIntosh, all the smartest people in the world.
yeah, it was, and actually for you guys probably don't know this, but George is the one that invited me to actually speak in front of the live audience for the first time. So I appreciate that very much. And I'm looking forward to doing your events in the future, but they're phenomenal, phenomenal events. So thank you so much for being here, George. And to everybody out there, listen to this more than once. This was such an important and informative conversation. And until next we meet, please be safe out there. Bye-bye.